Hey folks, welcome back to Total Money Management. We've got a bit of a special one today. I'm back with Steve. How you going, Steve?
Good, mate. Good.
So just to set the scene, so this property podcast special is called Property Problems, and it's essentially part 2 from the Stocks versus Property podcast that we released in early September, which turned out to be a bit of a hit, Steve.
Oh, there you go.
That's all right. So we want to. There's a couple of things here. We want to work through some very specific topics that not many people are talking about in regards to property investment. There's some very specific quotes, really, that are flying around in the market, and we want to make sure that we're talking about the things that people aren't talking about to give some context into whether you are going to invest in property or not and what that actually means. So I might set the scene. We've got an executive summary here, and before I get into it, if you want access to this paper that Steve's written, just reach out via email, support@totalmoneymanagement.com.au. We'd be happy to send it out. There are charts, quotes, and there's about 5,000 words here you can read in your own time with a glass of wine.
Over Christmas holidays.
Well, maybe, if you've got nothing better to do. So look, the executive summary. One remarkable consistent indicator of overvaluation is human nature. In investment markets, we tend to fluctuate between fear and greed, especially at the top or bottom of the market. Now, in Australia, residential property has experienced tremendous growth over the last 25 years, starting in around 2000. There's been a series of policy changes at the global and national level that have promoted residential property investment as a safe, low-risk investment to the point where many believe it to be a bit of a, quote, no-brainer. When people think that there is no risk in an investment, it is time to take stock and investigate whether such beliefs are actually justified or not, which we want to talk about today. So we want to show you how the Australian residential property market is not unique when compared to other countries, and all of those reasons suggested for why it are equally applicable to other countries, especially those that share the same economic philosophy with the Anglo-Saxon economy. So the UK, the USA, Canada, New Zealand, and Australia are really the worst affected. Now, we expect the Australian residential property market, like all markets, will experience a period of mean reversion, leaving some investors nursing potentially large losses. As we know, investing is a zero-sum game, some winners, some losers. Much trouble comes from the changing nature of residential property from a home to an investment class, which has become highly financialized. And we highlight the following issues as largely responsible for the explosion in Australia's property markets for the last 25 years. So there's number point 1, deregulation of mortgage lending, so increase in the number of mortgage providers. And point 2, securitization from the RMBS. Industry incentives in the finance sector result in a preference for mortgage lending over an actual productive investment. So that kind of sets the scene for some points we're talking about. You might be listening to this going, what the hell? But bear with us. By the end of it, we'll give you some actionable points to take away to think about before you invest. And on that note, I might pass to you.
Yeah, a few more points there. Just keep going down into page 2 there with foreign capital flows.
Oh, yeah, page 2. So we've got foreign capital flows as a result of some government's preference to maintain
mercantilist.
You put that in just to trip me up, mate. Mercantilist trade policies resulting in distorted capital flows. Asset prices, including residential property, exploded higher in some countries, including Australia, and the search for safe assets, quote, safe assets.
Yeah.
Tax breaks for investors, so capital gains, tax halving, along with first home owners grants, continued government subsidies at all levels, with investor preferences resulting in a booming demand but rather lackluster supply. And declines in social housing investment, the decline in public housing investment, which previously housed low-income earners, forced onto private rental market, pushing up demand and rents, as we've seen, particularly over the last few years. And these policy and structural changes have combined to make the cost of housing a serious issue for Australia, resulting in a major problem at all levels of government. Any further price movements, either up or down, will have large political ramifications, as all property stakeholders pressure governments for a solution. But property investment, like other forms of investment, is a zero-sum game, as I just said. Not everyone who buys or sells a property comes out ahead. That is not the way markets work. We know that. We now have 2.3 million landlords, and as a Labor and Bill Shorten found out in 2019, people who won't vote to reduce house prices or incentives. Yep. So there's so many landlords, they're not going to vote if the government's saying, well, actually, you're going to lose money.
Yeah. Essentially, what we're trying to do, and we talked about this before when we were putting the paper together, what we're trying to do is say to people, look, we take a bit of a contrarian approach, but also what we do is we look at history and other countries to say, well, is this time different? Yep. What is it different? What different about it? Now, what we're arguing is there's not a lot different, okay? And what we're trying to point out here is give people a different perspective as to why property is expensive, or why are houses talked about consistently on the front page of every newspaper, right? And what we're trying to do is give people a different perspective to understand where, again, things cycle. Why is it everyone suddenly decided that they wanted to buy a property? And that's why people respond to incentives and constraints. And, and we're going to talk about this a bit further, but, when John Howard said, I'm halving the capital gains tax, right, and I'm having first owners grants, well, naturally everyone said, let's go and buy a property. Yeah. Right, because that was the incentive, and that's what John Howard wanted you to do. Yeah. Right, so we responded, but they bring with it their own internal machinations, which then, and we've said this before, buying a cheap stock market with a CAPE at 10 is completely different to buying an expensive market with the CAPE at 38, right? They are not the same thing, but you've still got incentives going on, okay? So what we want to do, I just wanted to show you that because I'm a macro guy, I just want to show you that Australia's not unique, because you hear that a lot. Okay, we got lots of population and we got land shortages and stuff like that, right? What I'm trying to explain, and I do it more justice in the paper, I don't want to go through it, ad infinitum here, but what I'm trying to show you is that we are not unique. Please don't think that for some goddamn reason Australia is unique and we're going to have expensive property prices for as far as the eye can see, because that's what the Spanish said. That's what the Americans said. Right? That's what the Japanese said, and they all crashed, right? So I'll just give you a little bit of background here, okay? And as I said, I don't want to spend that much time on it. Yeah. Right, since 1900, the advanced economies have risen threefold, and the bulk of it in the second half of the 20th century. From 1870 to 1950, nominal returns were 1.5 and real returns were -1. Okay, so what I'm saying there is, listen, if you think property goes up at 7% per year or every decade, that ain't the case historically. After the war, they exploded to 6% nominal and 2% real. Even 2% real is not exactly knocking it out of the park. But again, well, why did that happen after the war? Well, because there was a whole raft of incentives put in place, demographics, right? The baby boomers came back, the fellas came back from war, and the government said, here's a block of land, listen, build housing on it, listen, we'll give you money for it, and to have kids, all that sort of stuff. But this is where I think it's really important. There was a really big incline in the 1980s, right? And particularly in the late 80s. Now, the reason why was because at that point, it was about 4 times income. And you'll hear this all the time, right? My parents paid, $50,000 for a property. Now, you generally go, oh, man, that is cheap. But when you look at it and say, yeah, but interest rates were 13%, you go, oh, that's terrible. No, it wasn't, because we had the wage rises to sustain the payments. Right. That's where it's different from today.
Is this Australia we're talking about?
Well, this is globally, right? So let me quote you an OECD study, right? Between 1980 and 2005, Financial deregulation, which we'll talk about, enabled an expansion of mortgage credit, led to an increase in real house prices by 30%, far more than any other variables. A similar IMF, International Monetary Fund, study extended to 2010 found that a 10% increase in household credit leads to a 6% increase in nominal average prices. Right. The study also found that increases in house prices lead to further growth in credit. This is the home equity line of credit, right? My property's gone up. Cool, I'm going to go.
I'll get another one.
I'm going to go and get an SUV, right? I'm going to put it on the housing loan, right? This provides strong evidence that increases in bank credit drive up house prices independently, right, of demand side or wider economic factors. Now, I want to just focus on that for a bit. What I'm trying to say to people is every credit bubble, and again, we'll talk a bit further about that, has an explosion of credit, right? The reason why is you can't go and buy properties without credit. So Australia is now at 190% household debt to GDP.
Yeah, just under Canada.
We've had an explosion of credit. Okay, tick that box, right? Now, we're going to go and talk about the other points that you mentioned in the introduction, right? And they all, I'm going to cross over here because they all mould in together, right? They all overlap and that sort of stuff. But the first point there is a 10% increase in household credit leads to a 6% increase in nominal average house prices, right? If you have a credit boom, you get an explosion of house prices. Now, as I said, independent of demand side, right? So what I'm saying is when people talk about population and land planning and, you know, all this sort of stuff, no. It really comes down to, you know, we say valuation is important in stocks.
Yep.
In property, it's the flow of credit. You go to the bank and say, dude, I want to buy a property. And they say, dude, you're not getting any credit. End of story.
Yeah.
You ain't buying it.
Even if you quote qualify.
Absolutely, right? The banks control the creation of credit. Now, the more they open the spivots, the more you're going to get people borrowing. Even, you know, low interest rates. Oh, that's the problem. Well, yes and no, because we've had housing booms where there's been high interest rates. Well, how does that happen? Because the banks open the
banks
spigots.
open the spigots and wages were rising.
Yes, and people go, hey, we can buy a property.
Yeah. So that's the important thing right now. The banks could open the spigots, but wages aren't rising proportionately.
That's right. And that's where it becomes a problem. So if we have a look at it, what we see is that the incentives for the bank, and as I said, I'm going to jump around here, but the incentives for the bank is saying the more loans I rate, the more money I make. Okay, tick. The other reason why it was really strong after the war, and particularly after the late 1980s, was some of those innovations we talked about that you mentioned in the overview. We deregulated mortgage lending, right? So when I was a kid, mortgages were 13.5%. Don't argue, that's what it was, 13.5%, right? Now, there were 4 places you could get a mortgage, right? Westpac, National Bank, ANZ and Commonwealth Bank.
Yeah.
Right? Okay. There are now 91 banks in Australia. Right?
Like little sub branches and
exactly. You know, the Bank of Watusi, you know, the Bank of Africa, the Bank of America, right?
Or
There's
if
all
you're
these
Steve's
places.
kids, the bank of Steve, the bank of dad.
Bank of mum and dad, right? Which is a legitimate argument.
Yeah.
But my point being, an expansion of mortgage providers is a result of more credit lending. Again, that's an indicator that you've got a bubble characteristic going on, right? So all I'm doing is saying, why is property exploding? Here's a list of reasons, right? First of all, bucket loads of credit going out there, right? Mortgage lending. Right. Secondly, you mentioned securitization, right?
Actually, just for you on that, if I think about the US and the GFC, there was a truckload of lenders there.
Yes.
The GFC hit and wiped half of them out.
Yes.
So I'm just forming a correlation between two countries that are not unique.
Yes.
That could happen here as well.
And see, that's again what we're talking about, Jacob, here happens everywhere.
Yeah.
Right? That's why I'm saying we're not unique. Right? That's why Spain had a bubble. That's why Portugal had a bubble. That's why US had a bubble. Right? Well, that's why Japan had a bubble. Right? Why? Because everyone was borrowing money hell west and crooked. Right? And why? Because property was never going to fall. Right, that was the new era and the new thought, right? Property will never fall. It goes up. All you got to do is buy it, right? That's the same thing. It happens everywhere else, right? So the big one or a big one is residential mortgage-backed securities. Now, this is a little bit of detail, but what it means is banks can then give you a loan and flick it off to someone else who buys it as an investment, right? So this is how it started. You got all these excuse me, these people looking for a safe asset. Interest rates are really low, so you're not getting a great yield. Bloke comes along and he says, listen, I've got an idea, right? Now, this is how you financialise housing, right? We all live in these houses and we work at the factory and we stay in the house for 40 years because it's not a financial asset that we flip. So the world changes and we get deregulation, we get globalisation, right? So all these things are going hand in hand. So this guy says, I've got this great idea. Why don't we package up all these properties and we'll put them in a loan. We'll get them rated AAA. They then become a, quote, safe asset, and I'll go and flog it off to Jacob because Jacob's got $1 billion and he wants to get a yield. So we're gonna say to him, listen, mate, we can give you 4% in these residential mortgages. You go, and I go, Jacob, they're rated AAA by Moody's. You go, okay, that qualifies, right? Bingo. Now, the bank says, this is great because I can just loan it and dump this shit onto Jacob, right? Because you've done the transaction, right? That's what happened in America. The mortgage broker was just writing any loan, right? Because they didn't have skin in the game once they wrote the loan. It was over to somebody else, right? So what you find is that as people like me get older and we go, oh man, I've got all this money, what am I going to do? What we're doing is buying, as we mentioned, I think in one of the podcasts, we're buying more and more of the property, right? Because we've got more and more of the money. So again, this comes back to income distribution, right? I can't afford a property. Why? Because my wages are going nowhere. You, on the other hand, go, I'm 72 and I got a heap of assets. Well, I'm going to go and buy a property, right? Now, you might buy it for your kids or you might put your kids in it. But either way, we've got this income distribution, which is badly weighted. And I'll talk a bit more about that in a second. But the banks basically said, now that we can securitise these mortgages, we can free up lending, right? Banks also said, why would I lend Jacob if he wants to do this risky manufacturing thing? Really, man, you should be doing that in China, right? Now, what I'll do is I'll lend it to Steve because I've at least got collateral over the house. Right? So if the loan goes bad, sorry, Steve, we're taking the property. And I only lent you 80% of the valuation. The property's risen a little bit, so, my risk is low. Okay, now I'm just going to times that by 1 million mortgages, right? And so generally, that's what the banks have been doing. Hence the reason why the banks are all outrageously expensive. Commonwealth Bank's on a PE of like 28 or something, right?
But from what I thought happened, and I could be wrong, was countries learnt from the GFC, or they, quote, said they did, and brought in all these insurances and quality checks to make sure that these residential-backed securities could actually be paid and they wouldn't go back. So Australia now has all these insurances and things to make sure that does not happen.
Well, yes.
And that's the argument, right? So
yes, that's the argument.
Australia brought this in, so therefore it's impossible to happen.
But what they did was, and this is again another part of the financialisation, what we've got a problem with now, which no one's talking about, is shadow banking, right? So we've got all these, quote, banks that are unregulated. And the IMF and the World Bank have brought this up and said, guys, we need to have a look at this, right? And everyone's like, la, 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 don't want to hear it,
drinking the
right?
Kool-Aid,
Right, because everybody's making money and nobody wants to upset the apple cart. Now, the problem is too, as we mentioned before, if, what politician wants to say to people, listen, I'd like to knock off 20% off house prices. Okay, every investor's going to go, yeah, pig's ass. I'm going to vote for someone who's not going to do that.
Yeah, or says they're not going to do that.
Absolutely. So, and now, final point. In the post-war era, the financialisation, you couldn't borrow against your house, right? So there was no home equity line of credit. And so that never fed into consumption of, my house, I bought $1 million house, excuse me, It's now worth 1.8. I'm going to borrow 100,000 on the loan, and I'm going to buy a Mercedes Benz, right? Because hey, dude, I'm worth 1.8 million, right? And so I should be driving a Mercedes Benz. That's what people do, right? You're raising your quote standard of living. Okay, so what happened? This is again where I'm pointing out post the 80s, where they were just creating ways to turn everything into a financial asset for money, right? And houses became money. And so, again, one of the issues about negative gearing is people will say, oh, well, we need negative gearing, otherwise there'd be no properties. Well, that's bullshit. Now, here's why it's bullshit. It's bullshit because people need a place to live.
Yeah.
We're not talking, the government wouldn't go, oh, well, everyone's just going to have to be homeless if you can't buy a property.
Just live on the streets.
Live on the streets, because we're not doing negative gearing, So that's why I say we had, people have lived for hundreds of years in houses where there hasn't been negative gearing.
Yeah.
Right? And that was tied to, again, governments who said, listen, we're financialising everything. We don't want to be in social housing. That's for losers. We're going to hand it over to the private sector, right? And so what happened was all the poor people had to pay more rent or go into the market for private housing, right? And were then forced to try and compete, right? So again, this is the problem with the supply issue. We need to supply more houses. Well, in the old days, that was government would say, listen, we build 50,000 a year because we got all these low income people and we got to house them and stuff. Right?
Or put them in
commission
in
houses.
Flats.
Yes. Now they're still doing it, but the spending has fallen for years, and this is why we've got a problem. Right now, yes, it's tied to immigration, and I get all that, but we have property bubbles without having huge immigration. And again, I'm going back to the argument. It's mortgage lending, it's greater financialisation, right? So they're the two really big ones, okay? Now, I want to talk to you about this issue, which is a little bit sort of complex, but it's a really important thing because this is, excuse me, this is where income distribution is really important. And a lot of it started between countries. I'm trying to see if I can do this in 5 or 10 minutes without everyone going to sleep. The debt explosion came after the Asian financial crisis. Right. Okay, the Asian financial crisis, it's the 90s. Asian countries are booming. They're exporting all this shit to America. Everyone's going, this is great. In Brisbane, in Australia, we've got, Alan Bond and Christopher Skase and Laurie Connell, right, all these dudes and land and all that sort of stuff, right? And they're all the new millionaires. Kerry Packer, Rupert Murdoch, who was the other one? Robert Holmes, right? The new entrepreneurs, right? Late 80s, early 90s. Asia's going gangbusters, right? Because we're now like China, we're sticking factories in Malaysia and all these places, and they're exporting their head off. Now, what are they doing? They're borrowing like crazy, right? Because they're going, man, we're all getting rich. This is great, right? So everyone's going, yeehaw. Then the joint crashes, right? And I won't bore you with it, but it crashes for currency issues and all that sort of stuff. Right, so then the Asians go, right, stuff this. We are going to earn US dollars and Australian dollars, and we are not going to exchange it into our own currency.
Right.
Now what we're going to do is we're going to say, no, if I got a big bucket load of US dollars, I'm going to buy US assets.
Right, okay.
Right? So I'm Malaysia, I make TVs, I sell it to America, I got a US dollar. Normally what you do is you go, okay, I'll
convert it back.
I'll make that a Malaysian ringgit, I think it is, and I'll pay the staff, and the Malaysian ringgit will circulate in the economy. Okay, what Malaysia says is, no, last time we did that, we caused a boom. The IMF came in and said, right, you silly bastards, you've got to be like our Western countries. The Asians went, no, we're not doing that. So then they go, okay, now I'm selling the stuff to the US, and I'm going to keep the dollar in the United States, and I'm going to buy government bonds, right? Or I'm going to buy the Empire State Building. So they start buying assets, which is what China's doing at the moment, okay? Now, here's the rub. All of that money comes back into the United States. And what it does is there's only two things that can happen. One is you get an increase in unemployment in America, and the reason why is America's no longer making TVs, they're getting them from Malaysia. And the Americans don't want that, right? Now, what happens? Okay, you get an increase in debt, right? Because now there's all these US dollars floating around, and the US banks, what do? We've got to lend this out, right? So they start lending to people. What do we lend it for? Well, Jacob's wages aren't going up, so Jacob says, man, I'm going to speculate in a property because the bank will say they'll give me money and I don't know anything about stocks, so I'm going to buy a property, right? John Howard comes in 2000 and he says, I'm going to give you halving of the capital gains tax, right? And I'm going to give the first homeowners grant, right? Because we are one of the countries like America, US, Canada and England who has an open capital flow.
Yeah.
Okay, you want to come here and buy a house? Come here and buy a house.
You don't need to be a resident.
Try doing that in a lot of Asian countries and they go, nah, you're a foreigner, you're not owning anything here, right? So what do we get? We get a flood of rich Japanese buying houses in the 80s, right? Now we've got a lot of rich Chinese and a lot of rich Indians, right? Because it's foreign money. Okay, so what we get, as I said, is a general debt explosion and the money comes from Asia, right? So that's a really, really important part of the story. And this is not Steve, working through it. This is also, it is a little bit. It's McKinsey's have put out studies going, guys, everybody's wealth is in global property, right? And here's the reasons why. Everybody is leveraging up because that's the only way that they can see a way to make their financial goals. Rich people are saying, well, I don't know much about stocks, but, I can go and buy a property. Yep. So they start buying properties. Rich Chinese go, if I can get my money out of the country, I can buy a property in Australia as a bolt-on.
Yep.
Right? And as safety away from the Chinese government.
Hedge, yeah.
Right? So there's heaps of that going on.
So it's, to me, if you've made money in another country, whether, let's just say the UK, for example, and it starts to get a little bit rocky there, i.e., let's just use Brexit as an example.
Yep.
You could sell up there or leverage up and buy a property in Australia or New Zealand or Canada or whatever it is. And
because they allow it.
Because they allow it.
Yes.
Yeah. Okay, that makes sense.
Yeah, so at the moment, there's now, if I remember correctly, Chinese have started to stop buying in Australia. But my point being, well, at least they're allowed to buy here. That means extra money. You see? So what I'm saying again is that what you're seeing is an explosion in debt as a result of the global trading system, right? That's why the Americans are saying, we've had enough of this bullshit where you guys won't open your markets, because what the Chinese are doing is saying we're earning all these US dollars, we're not going to convert them back to the yuan. That will raise the price of the yuan, that will raise the price of our exports, and we will have unemployment.
So they're keeping it in the country.
So they just keep putting it into the US, buying bonds and buying property and buying companies, buying anything they can. Now, they have to do that in the US because the money is so huge. So the Chinese can't say, oh, this year we've got a trade surplus of $1 trillion. Oh, I've got an idea. Let's go and look in Hawaii. Right, which is American. Let's go and look in Thailand and buy some stuff. It's like, guys, you can buy the whole bloody economy. Well, they can't do that, right? The US is the only place, well, generally the only place, that's large enough to absorb all this excess capital.
Yeah. Which is why 75% of...
Yes.
It's the 75% of the market.
Exactly.
It's feeding itself.
Yes. And here's an important bit. They don't really care that much about a return, because it's not about the return. It's about keeping the export machine going.
Right.
Right?
This is China.
This is China, right? We don't care if we're getting 0.5% in government bonds. We're just doing that so we can still keep exporting our EVs or our washing machines or our aluminium processing or all that sort of stuff, right?
Okay. So how does that relate into Australia?
Well, Australia has had the Chinese minerals boom. What happens? We earn lots of Australian dollars. And what happens? Banks lend it out.
Yeah.
Now, instead of saying, well, I shouldn't say instead of, they did lend money to mining companies, right? Because mining companies want to expand. But at some point, supply meets demand, and then the banks are still awash with money. So they start lending to property because John Howard starts off with the incentives, and then the other state governments all pile on board. Right, so now Queensland's got bloody first homeowners grants and stamp duty relief and, all these incentives. So what they're doing is they're pouring petrol on the fire, right? So when you look at it, let's talk about bubble characteristics, right? Okay. So you've got credit expansion. Now there's a chart in the paper there, and again, income's hardly gone anywhere. Prices have gone through the roof, right?
Yeah,
that's what we're explaining. Now, that's fine. When it really takes off is 2000. Now, what happens in 2000? John Howard announces the capital gains.
Yep.
Right? Okay, second part is securitisation, right? What do we got here? Residential mortgage-backed securities provide an important source of funding for Australian lenders, right? It backs around 70% of mortgages issued by Australian non-bank lenders and 8.5% for non-major bank lenders, right? Now, that's the RBA in 2022. What I'm saying is we have mortgage-backed securities in Australia. Please don't think we don't, okay? Now, marketability, right? Increasing prices leads to greater investment interest. Okay, that's a no-brainer. We know that's coming, right? Newcomers. Okay, here's the one I talked about before. What you see in a bubble is you get lots of new lenders. So as you see in your Facebook feed, you've got every man and his dog selling you, property investment advice and, hey, this is the biggest boom and all that sort of stuff. You've got an equal amount of people going, we're now a mortgage lender and you can come and, secure a mortgage through us. You got mortgage brokers with an incentive. Okay. So as I said to you before, Australia now at last count had about 90 mortgage lenders. Right?
It's outrageous.
Well, that's what I mean. You just keep finding you just keep going until you find someone that says, yeah, I'll give you a loan.
Yeah.
Right? Now, and that's another part, because what happens is once you lend to the rich people and the rich people say, I don't need any more, you've got to lower your standards. Right? And this is what we found out a little bit in the Royal Commission. Right, was that banks will lower their standards. And again, they have to keep the loans going. Once everybody's got a loan, the only people you can loan to are the people who generally you wouldn't lend to, you wouldn't have lent to 5 years ago.
They're not the A grade
suspects. Yeah. Now, Warren Buffett said, in the GFC, when the US was going through this, what they found was that the lending had got down to the lowest income in the cheapest, sort of shittiest suburbs.
Right.
Now, the reason why was because everybody else had already got a loan. Right. So there was only the poor people left. Yep. And Warren Buffett said, the mortgage broker would walk in and say, is that your cat? Right. Because these people have got no assets. Right. So he walks in and he goes, is that your cat? Yeah. It's a $3,000 cat. Right. Okay. Oh, look, you've got 45 grand in assets. You can get a loan. Right. That's what they do. Right? And I can tell you they did that with a relative of mine.
That's insane.
Right? Who's earning, not a great wage and had $45,000 in home and contents. And I went, mate, have you got, and he was like, nah. And it's like, right. Okay. So this is what I mean when you talk about financialisation. Every incentive becomes, how do I get Jacob that loan? Right? I've got to get him that loan. Right, I'll bullshit on his income. I'll say that he's got one kid, not three.
Yeah.
I'll say that he's got a Mercedes-Benz or all of these sorts of things, right? People in the industry will go, oh, no, that doesn't happen a lot. Well, okay, I think they're being a bit generous. But secondly, it happens more than you think, which pushes it over and above the sort of normal level.
Yeah.
On top of that, you've got, in 2020, I think, Scott Morrison said, righto, now we're going to give, 25 grand to help you with renovations. Bingo. Home equity line of credit. Scotty gives us 25. We put in 250. We got a new kitchen and, my suburbs around me, I'm just absolutely gobsmacked. Right? At everybody looks like they're building a goddamn Hollywood mansion.
Yeah.
It's crazy.
It's all the same look as well.
Well, yeah, but more importantly, Jacob, it's just, why are these people doing this? And it's because, again, we've got this mania about the way to make money is to get into property. And I'm not saying it's wrong, but what I'm saying is you need to understand the background, you need to understand the drivers, and you need to understand how to think about investing, right? Because it's not just a matter of, I'm going to spend 500 making a reno and that'll give me 800 in value.
Yeah.
Right?
Well, I also think that the newcomer stage that you just spoke about before is very, very important, because that's the same in any market, in any asset class, where we spoke about it in the last couple of podcasts. This feels like a time where it's so full of newcomers, and we know newcomers tend to lose.
Yes, yes. It's always the last ones who buy at the top that are the first ones that really suffer, because they buy at the top.
Yeah,
right?
and they're quite often uneducated.
Yeah, yeah. So, well, the other thing is too, they're the last ones that the banks lend to, right? I said no to you 5 years ago, but Jacob, how are you travelling, mate?
I'm a bit desperate now.
you might want a loan, So, and that's why I say, if you look at housing prices and you look at household debt, they rise, right? There's a serious correlation, right? So, when you go, it's immigration and land planning and blah blah blah, it's like, yeah, but you've still got to have a rise in debt, right, to get the prices to go up. And so that's why I say, a simple question is, well, okay, why all of a sudden did people start to buy property in 2000? I'll tell you why, because that's where the incentives were.
They told you to go and buy there.
And it came on the back of the Asian financial crisis from 97 to 99, 97, 98, where the Asian countries said, we're awash with money, we're now going to put it in those countries, right? What marries that? John Howard comes out and says capital gains halving and negative gearing.
Guess what? Come here.
Well, you got a perfect storm with Chinese economy gets into the WTO, right? Clinton says, right, I let them in for the global system. They then demand, tons of commodities. We go back up and it's all booming again. Right? The American stock market crashes from 2000 2003. What happens? They start lending to property.
Yeah.
Why? Because they're awash in money again from the Asian countries. Right? So as all this debt just piling up, right? And that's what McKinsey's are saying. They're saying, guys, the debt's getting out of control here. And of course the governments are just going, okay, well, I'm not going to mention it.
Well, it's never going to get paid back. It's just going to constantly increase.
Yeah, if you this is where we get into, what are we going to do about it? Because you hear these things, and this is where we should probably address that. Just to go back one step, I won't talk about too much. We had a Melbourne land boom, right? And the point being, things get batshit crazy, and the higher they go, the longer it takes to fix up, right? So we should probably deal with the arguments.
Yeah.
Right. Because people will say, well, Steve, yeah, but the government won't let property fall. Right. So we've dealt with that. Right. And for the first timers who are listening, let me tell you, if governments could stop property from falling, they would have done it for the last 2,000 years.
They would have done it in the US, the UK,
exactly.
Spain, Portugal, China.
Right. No one's ever managed to deflate a bubble without anybody losing money. Right. That's not the way markets work. Righto. So the second one, property only ever goes up. Okay, well, yeah, but the question is, as an investor, are you making money?
Well, we covered that in depth in the other podcast as well.
Yes.
Property special.
Yes. And it again, what you realise is if you're in a bull market, then most properties will do all right, right? But it's when it turns that you get a bit of a change. Okay, and that's why it doesn't always go up. If you say property always goes up, that's the equivalent to me saying the ASX always goes up. Now, that's true, but there's a time aspect to it. The second thing is, yeah, but I'm not in the ASX. I've picked 6 companies, i.e., I don't care about the property market. What I care about is my property. And there's a difference going on because you might have 100 people making money and you going, oh, mine's not.
Yeah. Wasn't there a period in Europe somewhere of like 500 years where it was about a 1%?
Yeah, that's the
yield.
The Herengratch Canal in Amsterdam.
In Amsterdam, yeah.
They've got about 550 years worth of data, and that's why I say at the front there, the nominal return is 1%, right? And the reason why is quite simple, because if you said property goes up at 7% every decade, what that means is that the tunnel in Amsterdam would be about $42 trillion.
Yeah.
Right? Because you're compounding at 7%. Well, it doesn't happen like that. Right?
And your comment on time is important as well. So you might own a property for 10 years, 20 years, 15 years, or however long that is. What's the little snapshot of time that you're actually investing in?
Yeah.
Because if you're buying a property at the top of a bubble for 20 years, you might get a 2% yield. But if you've bought it after it's mellowed for a bit or come back in price, then you might get a 7% yield.
Yeah.
But when are you actually getting in?
That's the thing, right? It's always, when you buy. Okay, third one, fundamentals are strong. Okay, housing is no longer a fundamental. Housing is an investment asset class that people are speculating in. So what I'm trying to get across there is, you can talk about fundamentals, but what you need to do is talk about things that affect assets, right? Oh, it's population. Yeah, partly. But we haven't had booming population all the time, and we've still had property bubbles, right? So it's not just population. Oh, it's cheap interest rates. Well, no, because in the United States, they had property bubbles when rates were high. Oh, okay, well, it's land planning. Well, no, in some places it's land planning. And again, what I'm trying to do is say to people, once you start talking about financialisation of things, fundamentals start to lose the value that you think they have in terms of drivers. People are just speculating. They don't give a shit about property. They don't give a damn about immigration. They don't give a damn about interest rates. They don't give a damn about land planning. They just want to get a loan and they want to get a property because they're going to make money, right? So that's where you see this in stocks. Oh, it's a new era, AI is going to change the world. It's like, yeah, maybe just everybody's in AI stocks, right? Not because it's going to change the world, right? I don't buy stocks to change the world. I buy the stocks to make money, right? So, that's where you can say the fundamentals are strong. The other thing is too, a lot of people go, fundamentals are strong. Why? Because the price is going up. And if you can't explain why the price is going up, people go, well, it must be going up for a reason. Yeah, fundamentals.
You have to tie it to something.
Yeah. Imagine if I said to you, nah, it's just all these people going crazy getting loans and bidding up prices. You'd go, oh, well, that can't be right.
Yeah.
But that's what's going on.
It's quite often just people's psychology.
As I said to you, if you walk in and say to me, oh, Steve, your $1 million property is now worth 1.5, would you like to get a loan, mate? I think, actually, yeah, I might. I could probably upgrade the BMW. Or, oh, listen, I need to get my kids in. Yeah. Because the property market's just going to go up forever, so I need to get my kids in. And that's what happens, right? Property is a low-risk investment. No, it just uses a lot of leverage.
Yeah.
Right? Really, there's enough historical evidence which, as you mentioned before, people lose money. Some people make an absolute bucket load. Some people lose an absolute bucket load.
Well, the argument to that, it's a low risk investment because it is something. You can live in it.
Yeah, but I'm talking about property as an investment. And from that point of view, when you look at the yields, they're awful.
They're terrible, the Bennett.
They're awful. But people are looking at the capital gain, right? And it's the same in stocks, right? The last one, we need negative gearing. Okay, we dealt with that before, right? It's silly to argue that. Right, the government will argue that as well because they don't want to be on the hook to spend billions to house low income people. Right? Why not? Because everything's an asset now. Right? So people are into property flipping, right? They're into all this value adding. No one talks about it as Jacob, I've got this place, you'll love it. You'll raise your kids here. 30 years, you'll be working down the street. It's a great place, got a footy feel, you'll become part of the footy club. No, this is like, Jacob, this is yielding 2.5%. It's gone up 15%. There's lovely schools in the area, mate. You can flog this sucker for 1.5 million. That's what they're talking about, right? I hardly ever hear anybody say home.
Yeah.
right? They all say houses or property,
Yeah.
right? So the argument is, of course, where do we go from here? God knows really. But
Thanks for listening, folks.
yeah, thanks for that. You're on your own. Well, no, it's just, look, it's, we're just trying to point out to people a different story. You can listen to us and go, Steve, you're full of it. It's like, okay, no problem, right? No problem whatsoever. I'm quite open to people going, you're wrong. Okay, that's fine. Provide me with counter evidence, not, oh, you're wrong because I've made $150,000 in my property, which, as we say, is a bit like, dude, don't mistake genius for a bull market, right? All I'm saying is, here is a set of reasons about why property's risen so strongly over 25 years, right? There's McKinsey studies to back it up. I've gone back through history and said, look, this is where it's happened elsewhere. Oh, okay, well, that's something to consider. Here's the wages debt dynamic. Oh, okay. Here's the debt house price correlation. Okay, well, that's if you come back and say, I still don't believe you, it's like, okay, no problem. I've got no problem with that. That's what makes a market.
Yeah.
But at some point, Australia has to decide whether we end up like Japan, which means you're going to have a lot of property owners with an expensive property that doesn't make any money, but they're just grinding out, paying it down.
With help from government incentives or no?
Well, yes and no. Or
does it depend how many?
Well, yeah, largely. Because, see, we've got 2.3 million landlords. That's a lot of votes. If you came to me and said, listen, I'm thinking about doing X and, that'll lead to 300,000 off your property. As an investor, you're going, no, mate, I'm not voting for you. That's why they're not talking about the real issues, because they know it's a vote loser. Who wants affordable housing? Well, a landlord doesn't.
No.
Because he's not in it for the yield, he's in it for the capital gain. So, it's code for, I'm going to knock off your capital gain.
Well, if somebody builds 10 cheap houses down the road, it just takes the value of your house down.
Yeah. So who wants that? No one that I know of. So we've talked about this before. You've got the Japan scenario, which is zero growth for 20 years, or you've got the American scenario, which is it all blows up, and in 10 years' time, we're back, 5 years' time, they're back speculating in Florida and Texas and, Alabama and all those places again. And we'll be doing, we might be doing the same here. I think they did the same in Ireland. I think Ireland crashed and then, bingo.
Like crashed big time and then came back in.
And then came back again, right?
I think that seems to be the Western way of doing
Well,
things.
it is, Jacob, because there's always been debt to back it up, right? And so again, when the banks in the GFC, the problem was the banks won't lend to each other. Now, I'm not going to spend a lot of time on that, but what it says is the liquidity dries up. So you go to the bank and say, look, I want to roll over my loan, and they go, nope, in fact, we want the money back. What do you got to do? You got to sell the house.
Yeah.
Right? I'm having a bit of a hard time. I want you to stretch out my payments. No, we don't want to do that, Jacob. Right? Because they've now got 10,000 clients going, listen, mate, I'm struggling a bit. Yeah. So the banks are going to save their own skin, which is, no, you people have got to sell the property. That's risk. Right?
Well, they're already off the hook anyway.
Well, they end up getting bailed out. But, as I say, I don't know how it ends. Can it go higher? Absolutely. But as I say with stocks, it all ends somewhere. All we're trying to do is give people an alternative things to think about and go, oh, okay, that's interesting. I'll bear that in mind.
Yeah, through all of the bullish sentiment that you can access anyway, spend a few minutes looking at the opposing arguments before you make a decision.
Yep. And we've got indicators there. Like I say, once you understand wages to debt levels to GDP, okay, Australia's at a record. Okay, are we going to continue to pile on this debt? Well, we could, but at some point it stops. Okay, when does it stop? I don't know. But what I'm just telling you is at some point it stops, and we're the second highest in the world. What's all the debt going to? Productive factories? No. All the debt's going to unproductive property speculation.
Yeah.
Okay, well, that's not really a good thing. Okay, so there's a counterpoint, right?
Okay.
Oh, Stephen Jacob talked about financialisation, mortgage-backed securities. I'm going to go and look and see if how many mortgage lenders have we got?
Yeah.
How many banks and mum and dad are starting to throw money at their kids to get them into the market?
So from a risk mitigation perspective, let's pretend that we're all in the property market and we're listening to this, and
we are.
Yeah, we're not giving advice, but we're talking about people that are potentially thinking about buying an investment property. What about people that have one?
Well, you've got to go through the numbers, right? And there's two parts to it. And we have a session called How to Think About Investing, right? And at the end, there's a way you can value property like stocks, which is really, really simple. Now, it's not down to the dollar, right? But it sort of says to you, well, hang on, what's your earnings yield, right? Well, what's your rental, right? Oh, I bought it for $1 million and the rent's $50,000. Okay, well, that's 5%. And what's the capital gain? Well, I think it'll be 2% per year. Okay, 5, 2, okay, 7%. How much is the loan? The loan's at 4%. Okay, well, you're going to, you might do all right. What happens if the capital gain is not 2 and is actually -5 over the next 10 years, which is your time frame? Oh, in that case, I really should think about selling. Mm-hmm. Right? So what I'm saying is it's like stocks. You've got to look at the numbers cold-heartedly and say, am I going to, is this sucker going to continue to go up at 7% per year?
Yeah.
Right? How do I know that? Well, you can look in the Sydney papers and you see all those articles about, Pizza Boy made $42 million with 25 properties, right? I make more money out of my property than I do out of my day job, right? That's what happens in stocks. I make more money day trading than I do with my, I'm retiring to become a day trader. Okay. Every man and his dog seems to be a property investor or, has got a property secret, right? Jacob, these are the 3 suburbs that are going to boom. Oh, shit, I better get in. How does he know?
Top 5 things to make you
a property investor, right? Financial independence, retire early. How do you do it? You just buy heaps of property and flip them and, you got $3 million and away you go, right? All that sort of stuff is saying to you, that looks like that asset class is well and truly overvalued, right? Yeah. And it's a hard decision to say, I bought it $1 million and it's worth 1.6 and, I just feel like it's going to go to 2. But we do that with stocks, right? You have to look at the stock and go, yeah, I know I've made a lot of money, but God, everything's telling me it's expensive, but it just looks really good.
Like, what's your exit strategy?
Right, exactly. And that's what makes investing, interesting, but a little bit difficult.
So we'll wrap it up in a sec, but the next 5 to 10 years, we're not oracles. We don't actually know what's going to happen. But what if you were in a position that you were investing in a lot of property, and let's pretend that you're Steve the property man, not Steve the stock man?
Yep.
What would you be looking to do?
Well, I'd be doing the same as I do in stocks, which is I'd be looking at some way to try and raise some capital, whether it be selling properties and that sort of stuff.
Yeah.
The other thing to do is and this is probably a little hard, but the other thing to do is watch what the gurus are doing, right? Watch what wealthy people are doing. Wealthy people like Warren Buffett who say, this stock market's nuts. I'm going to sell an absolute chunk of Apple, right? That, this guy's been, what is it? This is not his first rodeo.
No.
Right? So look at what the rich property investors are doing. Maybe they're selling. Okay, well, maybe you want to have a think about that, right? Because they're the people who have gotten rich via property who know how the cycles work. And separate that out from the people who, as Buffett says, don't ask a barber if you need a haircut. Don't ask a real estate agent if it's a good time to buy a property. Right? Why? Because, dude, they make $50,000 from a property. Of course they're going to sell you one, right? Or a mortgage broker or a buyer's agent or, somebody connected to the property industry, right? Because, and I'm not being rude, I'm just saying, well, that's the way they make their money.
Yeah.
Of course they want to sell you something or buy you something or, believe it's going to be really good. But that's why I say go through those things we've talked about and gone, okay, well, yeah, but, We haven't got any skin in the game. We're just saying to people, listen, you might want to have a look at household debt to GDP because it's a real indicator, or mortgage lending, right? Or securitisation, blah, blah, blah. That's all we're doing.
Yeah, here are 5 or 6 things to look at before you actually think about it.
Absolutely. Well, they're just things we want to give people for them to go, okay, I might have a think about that.
Yeah, it's good. I think, are we good to...
That's it.
Good to wrap up. Thanks, folks. So again, that's Property Problems Special. If you want the paper that we're reading from, reach out via email. You can get it on our website or socials. Thanks very much.
Excellent. Cheers, folks.
As always, remember, we don't provide financial advice.